Good Friday afternoon to you. It's great to have you along for this edition of The Call. 10 stocks picked by you, 2 expert guests, all in 1 hour. A warm welcome to those of you joining us on Twitter and Facebook as well. We run this program every day from Monday to Friday, 12 to 1 p.m. Sydney time, and we get it up online shortly after if you do miss a beat. Or, I'm told, a lot of people listen to it again just to get some of those more minute details coming through the conversation, which sometimes goes fast and furious. It's a Friday, and we've got the dynamic duo reunited. We have Claude Walker from A Rich Life joining us, Rudi Filapek-Vandyck from FNArena. Look, these guys often agree, sometimes really don't, though, so it should make for an interesting program. How are you both today? Starting with you, Rudi.
Well, you can see.
Lord.
I have been in lockdown for a while.
Yeah, well, I'm starting to look like John Bon Jovi or something in the early 90s. Claude, you're looking very respectable.
Oh, thanks. I don't know about that, but I'm definitely also without haircuts. That's okay, though. I'm keeping my spirits high and staying grateful for all the things I do have, so that's good.
That's a good sentiment for this Friday. I'm going to get right to it today. Our stock of the day is TechnologyOne. The company is making its first global acquisition, paying just over $22 million for a UK edtech firm. T&E will pay half up front, with the remainder being paid out based on the UK company making progressive earnouts. So that's the detail there on your screen. TechnologyOne shares, to timestamp this, just past the noon hour here in Sydney on this Friday, up by close to 3%. Rudi Filapek-Vandyck, FNArena. What do you make of it?
Well, as everyone knows, I'm a shareholder, have been for quite a while, intend to be for a long while. Probably good to point out that this is an all-time high in the share price. And what that means is that it doesn't matter at which point one would have bought these shares, including this morning, we would always sit on a profit. And that's quite an achievement for a company that has been around for a very long time. And for everyone who's a value investor, I'd like to make a comparison with the banks and with Harvey Norman and etc. So that the difference there is quite pronounced. Now, today's acquisition is actually more of a sentiment booster, I believe. TechnologyOne grows about mid-teens every single year. That is predominantly on operations in Australia. A few years ago, it did go into the UK. That has been a rather slow progress being made there. I can only assume that a pandemic doesn't really help. I mean, today's acquisition, to put that in perspective, this is a company that has about 100 million in free cash flow on an annual basis. It makes an acquisition of 20 or 22 million, so it's actually quite small. But what it does do is it probably improves its market entrance in the UK, and that's obviously why the acquisition has been done today. So it basically improves its ambitions in the UK.
And that is what the CEO said, just accelerating that growth in the international higher education sector. It's also really leveraged to government sector as well, Claude. I think what Rudi was implying in that answer was that, you know, TechnologyOne is a buy today.
Well, I wouldn't be surprised if that's exactly what he was implying, because TechnologyOne's well known to be one of his favorite stocks that he's liked for a long time. So, yeah, full credit to you for that, Rudi. Good call. I agree with Rudi generally that this is a high-quality business. It's one of the better ones. There are a few concerns some people have around the business. It can get a bit confusing because the first half cash flow is always negative. So if you just look at the most recent results, it looks like their cash flow is really bad. That usually bounces back in the second half. So it is a decent quality business. It's got sticky clients, it's enterprise software, so it has sticky software basically, and it's profitable, good margins. I think that when Rudi and I last talked about this one, I pointed out that they were sort of increasingly telling the story of being a recurring revenue business, high ARR growth as they convert clients to that. So that's a positive for it too. Having said that, I couldn't argue it's particularly cheap based on its most recent annualized recurring revenue. I think it's on about 20 times ARR, which is not really low, but it's not super high given that it's a fairly high quality business that has a long history of profitability. I think the final point, the final reason that I've always been a little bit cautious of this business. And I think I've probably, just not appreciated that their software was better than I thought it was. It certainly is sticky. And also there's some stuff has come out in court, past employee disputes and stuff like that has reflected not so well on the CEO, which has given me some kind of pause there. So I'm not a shareholder myself, although I have to say, given this must be up about 300% since I first looked at it and decided it was too expensive all those years ago, even though if I say today I still think it's too expensive, then you've got to remember that I've said that and been wrong in the past. So perhaps it's more of a hold for me based on price, but just with the caveat being I've said that incorrectly before.
But Rudi, you don't mind paying for quality companies. I mean, I've known you long enough to know that, correct?
Yes, that's correct. And the best strategy you have with companies like TechnologyOne is not to get too bamboozled by the numbers, because the numbers don't give you the true story. It's about having trust in management and having a long-term perspective. And as Claude said, I mean, and we will discuss a few other stocks today. If you are waiting for those stocks to become cheap, you will never buy them, and that means you are going to miss out on tremendous returns. And investors should at times adjust to the overall environment and not get too bogged down and waiting for a low PE, which they will never get unless disaster strikes, and that's the time when you don't want to buy them.
Mm-hmm. Yep, got it. All right, so that's the stock of the day, TechnologyOne. Let's move on to a company that has been nominated by Oliver. This is one that I know we have discussed before, but I think it's worthwhile revisiting in the wake of reporting season. PME, Pro Medicus. Over to you, Claude.
Oh, isn't it delightful to start with TechnologyOne and Pro Medicus? Just two real high-quality software companies that it's hard to say too much about. Yeah, so Pro Medicus, of course, for the only people that don't know, must be only one or two right now. It's my largest holding, still it has been for a while, so I might be a bit biased there. But the reason is I've made it a long-term, high-quality holding and actually held on even as the multiple got really high is just because it's a well-run company with well-aligned management, and also it possesses a really great positioning in the technology stack for radiology services. So what its specialty is the visualization software that allows radiologists to basically do their job better, quicker, faster, and from anywhere. And of course, that is going to be acting increasingly as the platform on which, one hopes that AI algorithms will be increasingly assisting that radiology process and making it even more faster and accurate. And so basically, the way to think of Pro Medicus is by making radiologists in the US in particular more efficient, it creates value for the people, the hospitals and stuff, their employers who are paying for their services. Yeah. So wherever radiology costs are really, really high because they haven't trained enough radiologists and the radiologists are earning millions a year, that's where Pro Medicus can come in and just save so much money and make so much money itself, because it charges on a per scan, mostly on a per scan basis. So there's a great structural growth story. Its tech stack positioning is perfect to maximize the chance that it gets to clip the ticket essentially on AI-assisted radiology in the future. Turning to the results, the second half was its record half of profit. That grew 15% half on half. That's not year on year. That's just half on half, 15%. And, an increasing amount of that is recurring revenue as well, or it's that transaction revenue that's sort of quasi-recurring in nature and is actually, in my view, better because it's leveraged to the increasing number of radiology scans. So against all that, it looks pretty great to me. It was really fully priced going into the results. If, to my surprise, it's gone up another 10% after what were great results, but we already knew it was a great company. I don't know how the market get more excited about it than it already was, but it did. Had great free cash flow relative to its profit, basically completely strong and things looking good ahead. The only catch is its price is so crazy I can't justify it. So it's, I think, around 190 price to earnings. Actually, it's higher than that. I think it's 200 price to earnings multiple. So I was saying TechnologyOne was cheap on around 60 times. This is 200 times earnings. It needs to have a lot of growth there. So for that reason, I would struggle to call it a buy at this price, as I just think that a lot of the goodness is already priced in. So for me, it's a hold. I still hold some just because it's such a high quality company. I'd argue the highest on the ASX.
Yeah, I know that you've said that before. Just a quick follow-up. Morgan's, and I read this on FNArena, is advocating that holders with outsized positions trim into price strength.
Yeah, I'm glad you brought that actually, because I've said this before, but I'll say it again. I have actually trimmed this stock. It would be like 80% of my portfolio otherwise. I've trimmed it before the results. I've sold a very tiny amount of shares above $60 just because I wanted to know that I had sold some if it crashes from here. But I'm not particularly active in this stock right now. I'm just holding on. I want to see what the future holds. I've taken a lot of profits above the $50 range though as well. So, and even below that in the years gone by. So yeah, I'm a trimmer of this one, but it remains my highest, my biggest position still to this day.
If you were a holder, Rudi, would you be trimming now?
Now probably not, to be honest. I would have trimmed $10 higher, which it was at some point. I mean, there have been a time when, and for quite a while, when both Claude and I were shareholder in Medicus, where we both agree is that companies that are high quality, and growth, like a Medicus, they tend to surprise on the upside, and Medicus has done that time and time again. Where we a little bit disagree is that with such an excessive valuation, which I assume is purely momentum play, and some people jump on board because it looks good on the charts and because everyone else is buying, etc., 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 is that there comes a point where you sort of have to question, like, do I still own these shares? $70 is at this point in time is a lot. Long story short, I'm convinced this stock will be worth $70 and well beyond in the years ahead. It's just a timing thing that it goes there very quickly at this point in time. Now it's a little bit above $60. How much exactly do you pay for this company? That's a question that nobody knows, because the market doesn't necessarily give you the opportunity to come in at a lower level. Having said so, this is, and I would assume that, I mean, that's been my call for companies like Medicus, like TechnologyOne, like Car Sales, like REA Group, like Zero, and there are like CSL, like ResMed. There is a whole bunch of high quality growth stocks on the stock exchange. And if you're waiting to have those stocks at a low PE, you will never have these stocks in your portfolio. That's just a given. So we are missing out on tremendous returns. And it becomes a point of, at what point do you get on board? At this point in time, I have taken my profits a little bit more than Claude has. So I have, at this point in time, zero exposure in my portfolio. But I'm ready. All right. If stocks like the ones I just mentioned, and includes Medicus, if at some point they correct lower, or there comes not that long ago, Medicus had a very brief but sharp fall. I think it was earlier this year. If that happens again, you will probably find both Claude and myself, and hopefully some other people as well, simply jumping on board and going for the ride. Because just to illustrate what I'm talking about, when I got on board at $30 or below $30 on Zero, everyone thought that was expensive. Today, the share price is 150 plus. When you ask people, when do you get on board on CSL, they say something stupid like, at $120 I would be buying it. But it's $300 something. You're never going to buy it. Let's face it. All right. And I can use that example for ResMed, for REA. I mean, I bought REA at much lower levels, but I at one point thought that it was getting expensive at $65. It's almost triple that amount now, 2.5 times. So it gives you an idea that it's not in the numbers. You have to see the bigger picture and trust that management is doing the right thing, and that those industry dynamics continue.
All right, let's find out if the industry dynamics are likely to continue for Booktopia. BKG reported recently revenue up 35%, profit up 125%. They are printing these books, I shouldn't say printing, but they are shipping these books out as fast as they can. Can that continue, though? Do you think that pace of growth can continue, Claude?
Yeah, probably not. I think they've even said themselves that they see, customers splurging on books in lockdown kind of environment. And of course, with them being online only, like they're the natural beneficiary of, you're stuck at home, you can't go out, you're probably deciding to read more books and then you've got to buy them online. So their revenue is up 35% in the last year, which is obviously fairly phenomenal. And they've sort of say that it looks like genuinely they're going to be profitable this year. They weren't because of the IPO costs and stuff. But I love Booktopia as a customer, but as an investor, it's not so attractive to me for a few different reasons. So first of all, the recent IPO was an opportunity for like the founders and the insiders and stuff to sell, or existing shareholders sold out into the IPO. I think about 18 million. And then after that, the CEO and the CTO sold more shares at $2.68 to the market. So obviously some investors are really loving the growth story here and the potential. For me, the market cap's about $390 million, and that's about 28 times the underlying EBITDA. Now, I'm not sure how familiar the viewers are with Charlie Munger's definition of EBITDA, and I'll let you look that up yourself if you don't know what it is. But that's EBITDA. Underlying EBITDA is an even more rubbery number to base a valuation on. And so 28 times that seems pretty punchy to me. I'm the kind of person that is not going to value a bookseller based on underlying EBITDA, and we don't really have clean results. We don't have clean results yet since it's a relatively recent listing. So for me, at best, it's a watch and wait. But also a lot of the heuristics to me would be saying it's probably even a sell.
Got it. Rudy, how about you? I mean, I do note that $62 million worth of Booktopia shares, 16% of the company, exchanged hands early on Monday as well. So that's a pretty big move there. But it did beat its prospectus sales forecasts and upgrading them as well. So far, it's performing.
My favorite observation is that companies who list, they need about 4 years to show their true colors. And this is only 12 months. If you look at the price chart, it hasn't done, on a net basis, it hasn't done that much since IPO. I mean, admittedly, it has been in doldrums a little bit and then has recovered now strongly, and now people get excited. I share Claude's skepticism. I mean, I have some information that it actually, at this point in time, book sales in Australia are actually a little bit in a slump. I do not know how much of that translates into Booktopia's sales, but I'm a little bit skeptical. I think in the first instance, when we got into lockdowns, people were trying to make the best of it, and maybe they tried to learn something new, or they're all reading those romantic books they never had the opportunity for. But I think now they're getting bored, and I think books are out for the time being, and on any other case, I think they need still time to prove themselves. And I'm on the skeptical side, so I'd rather stay not on board.
So that is an avoid for you, Rudy.
Yes.
Romantic books. Okay, let's go to our next company on the list. Damstra, DTC is the ticker code. This is for Paul. Sorry, the previous one was for Nick, I think it was. Damstra Holdings pre-guided its FY21 result. Records all around, including cash receipts. The Vault acquisition is now fully integrated. Damstra is, workplace systems provider. They've got a number of different solutions that are used in the workplaces, and they've been able to adapt to COVID as well. Rudy, I'll start with you for Damstra Holdings.
Well, since Claude mentioned Charlie Munger, let me mention Warren Buffett. Most turnaround stories never really turn around. This was a company that also quite young on the stock exchange. I think Claude is, but Claude can tell the story later himself. I think he's enthusiastic because the share price looks cheap, and obviously the only way is up from there. But I'm skeptical about that Vault acquisition. That was not such a great company, and it probably wouldn't have become a better company since now it's owned by Damstra. And you can see from that chart that the market is actually really, really skeptical about what's coming out of this business. And for me, it's I can't see the enthusiasm that Claude has for this company. So I would just basically just leave it on the side. There's so many more better opportunities out there that have less question marks attached to them.
I think Rudy's sort of pre-guided what your comments might be there, Claude. But what do you have to say to that? What's your rebuttal?
Well, so this one I do own shares in Damstra, and this has been a roller coaster for me that I have not done particularly well out of. I first started buying it at around current prices in 2020, and it went on a great run, and it was up 100% for a while, and it was great. And then, unfortunately, what happened was they missed their guidance that they gave around the time that they acquired Volt, and they missed it quite significantly. Now, they say that that was partly to do with, basically COVID delaying some big projects, because what these guys do as their sort of core offering is they do they might have the machine that tracks who goes onto a site and who goes off it, as well as tracking, what the trucks are doing on a work site or a mine site. It started in mining. It does a lot more than that now, but it started in mining. It might track where the trucks are going, who's in the trucks. They also have the Volt acquisition was about getting Volt Solo, which is something that goes on your phone that then tracks the workers around a mine site like that as well. So it's basically about, tracking and managing, so for trucks, they need to make sure that this has been maintained properly and stuff like that, or it's a workplace safety issue. If you don't maintain the truck, it breaks down, a driver hurts himself, so you've got a problem. So that's the kind of thing that they do. And basically, it is software driven, so it has a little bit of hardware that will go on the machine to track it, or at the gate to see who's going on and off a site. And that little bit of hardware makes it sort of a stickier relationship, because you've got something physically installed with the customer, but then they just charge an ongoing software subscription for the use of the software platform. They call it their enterprise protection platform. Now, we've discussed the narrative in the market, and that's the sociological study of markets, and that's ultimately what's going to decide whether you make money on stocks or not. Does the share price go up or down, essentially? However, if you actually just zoom in on the fundamentals of the business here and ignore the fact that they've created this mess by giving guidance and missing guidance and all that sort of stuff, you've got a situation where they've grown their user numbers by 74%. They've added 27% new clients in the last financial year. And even though the actual revenue wasn't as good as they thought it was, it's still significantly bigger. And even in the sort of unimpressive year for the organic growth in the actual core Damstra business, we're seeing that pick up in the final quarter of the year. So you actually are starting to see signs of a recovery. Now, what we do know is that they've said their annualized recurring revenue is 34.5 million. And that should imply that revenue will grow at least 25% in this current year. And if we use that 34.5 million as the sort of basis of comparison with other software stocks, then that puts it on about 5 times ARR. Now, that's because of all of these issues we've discussed. Also, the fact that the company has some debt now, so it really needs to reach cash flow break even. So it's getting more high risk. So this could either be the dark days where it gets break even, it starts emerging for this mess, and I'm almost certain that at that point, people will start being more interested in it and the multiple will increase. Mm-hmm. Or alternatively, it fails that, it doesn't get cash flow break even, it keeps chipping away its declining cash reserves, and then the market's going to start smelling blood and assuming that there'll be a capital raise. And so it's definitely a high risk moment in time for Damstra. Personally, I am backing them to succeed, but I can be wrong, and that's the nature of small cap investing. Is you're taking a bunch of bets that you think the risk reward is in your favor. It may or may not be, and I'm still sticking with these guys because I like the longer term story, the massive growth runway, the decent gross margins, and all of that, and the decent multiple. But that it could go the wrong way if they don't get that cash flow break even.
So that is a hold if you're in it. It's not a buy.
You know what? It actually kind of is a buy for me. But it's just a buy carefully and not too much in it. So I'm not buying more, but I would buy at current prices.
Rudi, we'll just have to move on to the next company. I can see your smile there. PWR Holdings, PWH is a ticker code. This is for Julian, who says, I think it's a great company, but just not sure what a good entry price would be. It seems to be running away from me each time the price looks attractive. So this is a company that produces high quality, lightweight, performance aluminium cooling products that it sells into different markets. What do you make of PWR Holdings, Rudi?
And I think the comments made by the viewer is exactly what I was trying to say with the likes of TechnologyOne, Medicus, REA Group, Zero, you name it. If you are waiting for some low point, then you're probably never going to get on board. I mean, the investment thesis, which I also recently said to someone who asked me about FNArena, which is today or this week is doing a capital raise as well. The investment thesis for these companies you will not find on the balance sheet and you will not find in the numbers. What the investment thesis essentially is that these guys have now proven to be very good at what they do, and that's cooling systems. And they've now potentially are now expanding their market because they're now moving into defense and aerospace, and maybe even in space beyond the Earth. What that means is that if management can execute even moderately on that potential, that share price will be a lot higher in the years to come. They do cooling systems very, very well. They do Formula One and race cars and all of that. But if they can moderately execute on their potential, the share price will be a lot higher. So when you get on board, well, you can't get on board on a cheap multiple anymore. The market has now picked up on that. So you will have to get on board at some point where you feel comfortable. And that might be on a pullback, that might be by averaging in, or it might be you wait for a market correction or whatever, or you just get on board and take a long-term view, whatever your strategy is. But don't wait for cheap share price because you may not ever get in.
Okay, so this is a buy for you.
Yes.
Claude, are you buying PWR Holdings?
Yeah, so I actually bought after the results. They put out these most recent results, which was strong growth across the board, revenue, dividends, earnings per share, basically another good set of results. And just like this viewer, Julian, I've been looking at these guys now since they were like under $3 and thinking, oh, this is an interesting business, but it just seems a bit expensive. So it's gone up so much in that time. Now, the problem is it's a PE of 50, right? So that's why Julian says, oh, it's just always so expensive. And what I would say to that is what I do in this scenario is I'm anchored to that $2.87 that I looked at it years ago and was like, nah, too expensive. That's what's in my head every time I look at it. I'm like, oh, I'll just try and get a better price. So what I did is I just bought a tiny bit of the shares in the company, which I call a research position, which is just to reset my psychology, make sure I'm following on with the story, and so that I can have that connection with the stock so that I will get to know the business better. Because after I looked at this years ago, and then it kept on going up and up and up, because I'm talking even on the 5-year chart you'd need to see, basically it's gone up so far that it hurts me to look at it. So now I own a little bit. I'm going to follow the story more closely, but it looks like basically the conference call was very positive in my opinion. Basically, it sounds like they're very enthusiastic about the market opportunity before them. They basically think that it seems like from some of the comments in their presentation, basically said the online store is ready to go live subject to production capacity. It sounds like they've got a lot of demand. They've got a lot of products they can be building, which is a great place to be because it means that as they invest in being able to create more products, their revenue and profits and everything are going to go up. And shareholders are going to get to find out how long they can keep doing that run, how long can they keep growing and growing, and that will determine whether it justifies the PE of 50 or not. But it seems like a really high quality business, so I've actually bought a little bit just so that I follow along closely, because overall my strategy is similar to Rudi's in the sense that I do want to be overweight quality business and I do want to be following those businesses.
Tick, so that's a buy, and a buy that is going in the ausbiz portfolio. Let's get to the last one before the halfway mark. There you go, guys. We got there. TechnologyOne. Pat has written in saying, I'd like Claude Walker's view on this one. He mentioned TechnologyOne as in his stock portfolio. Likes the story. Purchased at $6.50. Plan to hold long term. Question is, what are the key risks to this company other than, I suppose, execution risk and not being able to gain more market share in Europe? So just answer the question, do you still like TechnologyOne? Would you get into it now? What's the biggest risk, Claude?
Yeah, so I definitely still like TechnologyOne. I'm not buying more shares myself now, but if I didn't have any shares, I'd probably buy some shares in that. So what TechnologyOne does is does software for participants in energy wholesale markets. So energy trading software. Obviously, that's like quite core to those operations, so that means it has a stickier thing. There's still part of the market where Energy One is not competing against other software providers. They're competing against companies that have built their own solutions, and it's not always practical for having each company having their own solutions. It's usually better to be using the software of the sort of experts. Now, in their most recent results, I think that the company was warning us that even though their results this year showed massive increases, they've increased the dividend from 3.5 cents to 6 cents. They've got huge increases in profit for these most recent results, but they've basically been saying that, it looks like it's going to be a little bit harder in the year to come, because what's happened is that in the year gone by, because of COVID, they've cut down their marketing and sales expenses because there was no traveling around and that kind of thing. But of course, they haven't really lost any clients during that period. So in fact, they've increased their revenue considerably, so their profits have gone up heaps. This year, their sales is going to be more difficult because they haven't been having as much sales and marketing activity in the last year. Plus, they're going to increase their sales and marketing costs. So it might be a tougher year this year for Energy One. Definitely a good time to sort of watch and wait and see what the share price does. If that profit number, they're guiding for maybe roughly flat year on year. Now, they may do better than that, but the point is that could see the share price come down, and it could be more attractive than it is right now. Having said that, at the moment, it still seems like this is a profitable software company that's more or less trading on a hefty profit multiple. But if you compare its recurring revenue multiple to other companies that are similar, it looks quite cheap to me. It's about 7.5 times recurring revenue, which is we were talking about TechnologyOne on 20, and I think, Medicus on 80 or something like that. So you can see that compared to other software as a service companies, in my opinion, it's still fairly cheap.
All right. So that's Energy One from Claude. Rudi, are you going to agree? What's your view?
I'm going to respectfully disagree with Claude. The comparison is often made, but there's a reason why Medicus and TechnologyOne trade on higher multiples than this stock, is because they are proven winners, and there is less risk attached to their growth trajectories than there is to this particular company. We've spoken about this in the past. I can't get excited about it. I definitely can't get excited about it at this point in time. And I think we all have limited wallets. Our money is not unlimited. So I think one of the key constituents of being a successful investor is you manage your risk. And there are less risky places, I think, in the market to put my money. So I'm not even considering this one in particular. So for me, it's a non-interest stock.
It's like it doesn't even exist to you, Rudi. All right, let's get across what we've learned so far. And our stock of the day was TechnologyOne. It has made its first overseas acquisition. This is a quality company that has proven itself. And you've heard Rudi say that a couple of times over the past half hour. It is a buy for him. But it's not for Claude, so it's not going in the portfolio, because he says while it is high quality, it's just not cheap, so it's a hold for Claude. Medicus, one of Claude's favorites. He's known for his deep knowledge of the company. It's a hold for him right now, though, because it's expensive. It is fully priced, great business. Rudi says it all comes down to timing as well, how much you are willing to pay. He would be trimming as well now past the result, but you do want to look for this company on a pullback because, again, it is quality. So hold for now. Booktopia, it's a sell actually from both of our expert guests. It just doesn't have the history for Rudi, but he's also just a bit skeptical overall. Management is selling, so that's not a great sign. They've actually done so twice. Claude says watch and wait at best. But yeah, again, leaning more toward a sell on this one if you're already holding it. Damstra, this is a buy, but it's a high risk for Claude. I'm not going to summarize what he said. You can go back and listen to it. It's been a bit of a roller coaster ride, but he is a holder. And quite a different scenario being painted by Rudi, who says that it's an avoid. He's like Buffett. He says most turnaround stories are never really a turnaround, so he's avoiding this one. PWR Holdings, it's a buy from both of our expert guests. It is going in the ausbiz portfolio. Look, Claude bought it after the result. Rudi again says perhaps there's no perfect entry. The investment thesis is that they've proven that they are very good at what they do. And we just talked about Energy One. It's an avoid, hard avoid for Rudi, again, hasn't proven itself, but it's a buy for Claude because he thinks it's cheap and he thought that the most recent result was pretty good, but you could potentially get it on a pullback if there is some execution risk or some pitfalls there in the months to come. All right, that's the halfway mark. Let's check in on the portfolio, courtesy of our partners at NAB Trade. 1 week return, 0.8%, 1 month, 3%. Year to date is over 5%. But of course, we have been tracking this since July 1st of 2020. And since then, the calls portfolio is up around 42%. So not bad. So today we added one. We've also added recently Resimac, PointsBet, Harvey Norman, Camplify, and ReadyTech Holdings. We've taken out, though, Appin, Flight Center, the Vanguard Global Value Equity Active ETF, and Western Areas. That's an interesting one. If you'd like to see that portfolio, you can go to ausbiz.co/portfolio. And if investing is your thing and you've got friends who are also interested, we'd love if you could tell them about us and to incentivize you. Cash Talks, you could win up to 6 prizes worth 10K, including $5,000 in a self-wealth trading account. So time is ticking. It runs out this week, but you can get your name and your referrals' names into that prize pool if you act quick. Let's get on with it, shall we? Gentlemen, Claude Walker is here from A Rich Life, Rudi Filapek-Vandyck from FNArena. The next company on the list is Pinnacle Investments for Peter, PNI. And he has written in saying, I'd like Rudi's view on this one, please. Outstanding results, great run of growth, price is high. So the question is, what's the risk? Example, Hyperion, which is leveraged to a lot of those big global tech names, was a significant contributor to the results. So he goes on to say, should we buy at any price in anticipation of ongoing growth? Rudi?
The answer there is, in this particular case, is probably no. I agree with everything that you just said, Nadine, and but I do think that the market is probably getting really, really excited about the recent results, and they were very good, and B, already looking forward into their next acquisition or international expansion. And I do believe that already part of that is now being priced in the share price. And that sort of means that your upside is getting a little bit moderate from here. Again, great business for those people who are not familiar with it. It acts as an umbrella, and it takes or it helps people with great ideas in the investment market, and it takes stake in them and basically nurtures them and brings them to market. And it has some absolutely great performers in its suite of fund managers and asset managers. I would prefer to be a little bit more cautious here and wait until the excitement has subsided. And I'm sure there will be better entry points at some point. Just take a look at what happened to the Magellan share price, for example. When all the excitement comes out of the share price, the price can be quite considerably lower. And that's a situation where you really don't want to be in, even though there are dividends on offer here.
Okay, Rudi, I'm sorry, Claude, do you see it differently to Rudi?
No, I think we could probably save a little bit of time on this particular one, because I do pretty much exactly agree with what Rudi said. The last thing I'd like to add to that is that a lot of times any group of society does herding behaviors, and a lot of times you see small cap fund managers do herding behaviors, and I feel like there's been a lot of love for this particular stock and this particular thesis amongst small mid-cap fundies recently, and you can see that beautiful chart of the last year. It's just been going up and up. That creates a lot of love, of course. And the other thing is they've been able to sort of see the performance of the underlying funds that Pinnacle owns shares of, right? And they've been able to see that those funds are going well and that they're going to have good performance and that that's going to be great for earnings. And that's the thesis. It's a very simple thesis that they've just been able to do the research, see that there's going to be good earnings, get in ahead of that, talk about it. Here, the good earnings have arrived. It's gotten so much momentum that it's still trading on like 40 times those really good earnings after there's been a great bull run. All of the funds have done really well, so the fees are high and etc. Of course, it's not just about Hyperion, which has done particularly well and has a lot of high valued stocks in it. but it's all of them are going to get hit, and all of the fees are going to go down if we have a market downturn. And you just know that the exact same fundies that have been singing the praises of this thesis on the way up, they'll be the first to spot that it's going to go backwards, and they're going to sell. And by the time a retail shareholder waits for the results and finds out, it'll already have moved. So yeah, my instinct is to leave this to the fundies. Maybe if you get in at a really low price, then it could be just a good long-term buy and hold. But I agree with Rudi, but basically.
Got it. Let's go to PlaySide Studios, PLY. For you, Claude, we'll start there. Ask him what's up with PlaySide Studios. He knows what the stock does well. What does he think of it in the wake of its report?
Yeah, right. So it's not one that I looked at particularly closely for the reports because I had sold it just beforehand. Now, I previously did own this one. What it does is it develops a variety of games, but their principal earner, or at least their most exciting game from a margin perspective, is I think called Animal Kingdom. I've got it on my phone, and it's like a very, very simple game, right? And the one thing that I noticed in the most recent report is that they're having to spend a fair bit in customer acquisition costs for these games, and that is supposed to bring a payback later because you basically supposedly acquire customers and they're playing your games for ages, and they're going to buy buffs in the game. Like you can buy stuff that's add-on that make it easier to win or whatever. Basically, it's like essentially pay to win. And my experience from having their biggest game on my phone for months now and sort of playing it from time to time is that I don't see how, I'm sure people must get bored of it quickly, and I'm not so sure that the customer acquisition costs they're paying now will pay off in the future. Now they might, and if they do, that's a great arbitrage, but that's essentially what you're doing here. It's like, it's almost, they've got a customer acquisition cost, they've got their ability to monetize players, and it seems like they're running it pretty close. Like, I'd like to see a little bit more comfort there that the lifetime value is definitely more than the customer acquisition costs. And I would also have more comfort if the games seemed more like long-lived individually, like that one person might play it for a really long time.
Well,
so as a result of...
I was going to say, it's Animal Warfare, so I guess you're not that into it. And they've got a couple...
I've got it on my phone. I've forgotten what it was called.
They're releasing another 7 games over FY22, including Godfather and Legally Blonde. Do you think you're going to be playing Godfather and Legally Blonde, Claude, more than Animal Warfare?
I probably will, because I'm going to download it to see if it's any good. Because if they do crack a game that I think is like picking up chatter on the internet and people are really into it, then that might be a great time to buy. But literally, that's sort of more or less how I decided to play it. Like I think the thesis is there, but I want to have games that I think last longer, basically, for the same person and have more potential is what I want to see. So that's why I sold out.
Yeah, good. All right, Rudi, are you going to be
buy aristocrat leisure.
Okay.
And that's all I have to say about this one.
Good one. And Aristocrat obviously reports outside of cycle, so I think we're looking forward to that report in November. Correct me if I'm wrong. So yeah, Aristocrat is the quality in the gaming space for Rudi. Let's go to Raise then. Raise is been brought to the attention by Ben. It actually got itself in the headlines this week when its CEO looked to spill the majority of the board. That has caught Ben's attention, and he has said, is it still a buy? Rudi, you were short and sweet last time. Let's start with you on this.
I actually have been following this company since it was called Acorns.
Yep.
It's probably illustrative of how competitive the Australian market is, that they actually moved away from Australia and sought and found growth in Asia. Now, I'm not a big fan of companies that have to avoid competition and have to find their growth. I mean, I can imagine if you, as an Australian company, enter Indonesia or Malaysia, that you have a little bit of a very good image around you because you come from a developed market. But I'm a bit skeptical about whether this is actually a high growth business, which it should be given its size. With regards to trying to get the current CEO trying to get rid of some dead wood on the board, that would actually be a positive in my view. Too many companies in Australia have dead wood in the boardroom, And there's plenty of examples there. And I think if he succeeds with that, well, that's a very good achievement on his behalf. But for me, again, it's way too small. It's also on a risk-adjusted basis. I wouldn't necessarily consider this company as an investment.
How about you, Claude? Again, there are quite a few sort of small cap fund managers that really like Raise.
Yeah, so actually Raise is a decent business, and I owned it not that long ago, just because I picked it up at around $1.45 and then looked to sell out actually at around current prices. But my idea was basically that they were making a lot of effort to promote the narrative and the investment narrative and the share price and stuff, and I could see they were doing that, and so I thought that would put the share price up. That doesn't really endear me to them long term at all. It just means that I can predict their behavior.
I remember that now, Claude. Just to let me interrupt for a second. Did that trade work for you? Because it was ahead of a conference that they were sponsoring, and you thought that there might be some short-term upside. Yeah, you can see on that
chart. I even sold too early. It went up to it went higher than I thought it would. It's not like I picked the peak or the trough here. I just had a little bit of the run on the way up. But I just knew they would if they're trying to promote their stock to people. It's a good story. It hasn't been much talked about. Basically, what it is it's like a little app on your phone that encourages you to invest spare change or invest regularly in ETFs essentially. And I think they have a part crypto offering as well now, which probably gets them even higher fees and stuff like that. They recently put up fees which they didn't lose any customers from, but I don't think the product's good, right? I think they're just they're charging more to millennials who haven't figured out that the best thing is to just open a brokerage account and buy low-cost ETFs. They're got this app that makes it a little bit easier to sign up, but then it has a higher fee forever. So, yeah, I think that business model can and will work, and there's a price for it. With all of this kerfuffle with the board and everything, we don't know how that's going to play out, so I'd avoid it for now. Having said that, it's probably in the hold zone for me anyway. It's not particularly cheap to my mind.
Got it. Now let's go to Brambles for Jen. BXB is the ticker code. Strong FY21 result. Now they didn't provide guidance, but Rudi, it's my understanding that Brambles will be providing guidance at its Investor Day, which is being held on September the 13th. Look, what do we want to hear at this Investor Day from Brambles?
We want to hear that they're finally cracking the barriers in Asia, and they're finally getting their pallets in order, and they can track them, and everything is hunky-dory again. I mean, I'm not the only one who looks for quality, dependable performance in the share market, and Brambles has long been presented as one of such character. It has actually disappointed and hasn't really lived up to expectations. I think I personally would say that, and they're often compared to each other, I personally think that EMCOR is a much better proposition than Brambles, even though Brambles looks cheaper than EMCOR. But I think if you want to own Brambles, you can, because it's not a very bad business. It's just it hasn't lived up to expectations outside of that rally that you just see that happened since March. If you take a longer-term view, it has been quite disappointing, and luckily they pay a dividend. But if you take a longer-term view, you have to think that they hopefully crack their entries and their expansion into Asia, and that could, for quite a long time, provide the company with a lot of growth under the wings. Now, so far, that's still waiting for that to happen, and it's probably a gradual and slow process. In the meantime, you do get dividends. So if you own it, it's not necessarily a dog that you have. You have a reasonable performer. It's not fantastic. If you don't own it, I would think there are still better and shorter dated opportunities out there, and EMCOR, I think, is one of them.
Thank you. Now, Claude, how do you view Brambles? Yeah, it's also moving into, I guess, the long transition into plastic pallets as well. Does it interest you at all?
Not really. It's just a really mundane, unattractive investment opportunity at current prices. I think that Rudi was right to focus on the dividend. This is, in my view, mostly should be thought of as a dividend stock. Its share price, if we go back 5-10 years, or even 5 years, I think, its share price is pretty much the same as what it was 5 years ago. There you have it. Actually, off the top of my head, it seems like I was accurate with that recollection. Basically, that means your return is coming from the dividend. Okay, so 2.3% dividend yield or whatever it is at the moment is probably not worthwhile. However, if you get the stock when it's in one of its doldrums periods, maybe actually that's going to be a pretty good dividend yield from what you paid. And because due to the distribution network, a global distribution network, it does have a defensible moat. So you would not expect this business to die. It could get a bit bigger, a bit smaller based on how well it's managed. So yeah, I wouldn't take it off the watch list completely, but for me right now, the 2.3% yield just doesn't seem that good an option.
Yeah, okay. Now, the final company on our list today, guys, EML Payments. Look, it looked as if it was a pretty strong result that came through. Now, it does have the remediation efforts with the Central Bank of Ireland, but Rudi, I guess remediation in Ireland is much better than, the alternative.
Yes, I think you're right, Nadine. The problem is that the market has already adopted that view, and you see that in the share price. The market is already pricing in that there will be a resolution in Ireland coming up, and it won't be that bad. So the share price is ever creeping closer to where it was when the announcement was made about the Irish operations. This is a company that was, I think, from memory, up until mid-2019, I believe, one of the champions in the small cap space, with tremendous share price appreciation. It has become a little bit tougher. Still, this company, just for people who are not familiar with it, this company is actually trying to be a bank at this point in time, and an alternative payments provider. And it has lots of tentacles stretching from left to right, and it's geographically moving way beyond Australia. This is still a small cap fintech. The potential is enormous, but success is not guaranteed. Now, I personally, I'm not thinking. I think I owned it for a while, but I got out of it because it's purely out of a risk assessment. The fact that management goes now into such a strong ambition beyond the original core competence of this company means that success is definitely not guaranteed. And I sometimes allow companies to do their thing and to prove to me that they're worth my attention, but I do not necessarily have to be on board while that's happening. So I definitely would not have gone on board after the Central Bank of Ireland had some questions. But I can see now that if that resolution comes, and it will come at some point, and it's not too bad, the share price will probably respond positively. So there's a trading opportunity, definitely. Longer term, we'll have to wait. It's all about execution, and it's not a guaranteed success, as I said.
I think that your mantra today is that the proof has to be in the pudding. Rudi, Claude, how about you? EML? Do you discount a company because it's got big ambitions?
No, I actually think that this has always been an interesting small cap ASX stock, and it still is. A lot of the focus right now is on this PFS business it acquired that's had regulatory problems and, a bit worse than anyone thought at the time of the acquisition. But the longer term thesis is still probably fairly attractive in my view because, and I'll keep this one brief and just high level, is basically EML, essentially provides the infrastructure, it's business-to-business infrastructure that allows other companies, to essentially process payments as it would appear to their customers anyway. And so that means what happens is EML profits more and grows as its own customers grow. And because its own customers, at least with the general purpose reloadable segment, which is the more interesting segment, long-term, the growing one, those customers themselves are growing in the general, as generally cash fades away, among other things. So for that reason, I think it's it's got the tailwinds, it's got a long-term track record for you to judge. There are some ups and downs there. To me, EML Payments is actually one of the ones that's on my list of stocks that I might consider buying. And the more that it appears that all of the skeletons are out of the closets in terms of the regulatory problems with PFS, the more I think we get closer to that optimal moment to sort of buy, because then the sociology, we won't be talking about this anymore in 1 year's time, in 2 years' time, assuming it's all over. And then the sentiment will increase and you'll probably get a lift just from that. So for me, it's very interesting. I won't call it a buy because I personally haven't got there yet, but I do think it's very interesting, and I'll call it either a hold or a buy.
Got it. Thank you. I'll sum up in just a moment. I'll take this time to thank you both for joining us throughout this hour, for giving us your thoughts and a few laughs along the way. Rudi Filapek-Vandyck from FNArena and Claude Walker from A Rich Life. We'll chat soon.
Thanks very much.
All right. Here we go. Getting to number 6 on the list, Pinnacle Investments. It's a no from both of my guests. Rudi just thinks people have become a bit over-enthusiastic, and Claude points out the herding behavior that might be going on. PlaySide Studio, it's not a buy. Rudi has given us a bonus buy, which is Aristocrat. Claude Walker was a holder, but he's just not as into the games as perhaps you need to be if you're going to be holding a company that essentially produces games. Raise, it's an avoid for Claude. It is a avoid for Rudi as well. He's skeptical. He doesn't necessarily believe that high growth mantra or a tag that it gets. Amcor is what Rudi would prefer over Brambles. Brambles is a hold though because it's a dividend payer, and that's what the plus side is of it all to Claude as well, but it's not a buy for him. EML Payments is on Claude's watch list, as you just heard, but well, Rudi has said throughout that he wants companies to prove it to him that they're going to be winners in the future before he necessarily gets on board. That's it for us this time around. Any companies you'd like us to cover, please drop us a line, the call at ausbiz.com.au. We do get to them as soon as we can, and tweet us at ausbiztv. You can also check out that portfolio at ausbiz.co/portfolio.